Good morning. I'm Joe Terrell, president of Terrell and Company Private Wealth Managers in St. Louis, Missouri. It's Thursday morning, January 13th. This is our first update of 2022 with our thoughts on the economy and also investment markets. Before I start, a belated Happy New Year to everyone, and we hope you're staying safe. It leads us into the first thing I want to talk about is the Omicron variant of the virus. This is spreading around the world extremely quickly and has the potential ultimately of perhaps being a positive. If there's some good news, it appears that it's not as dangerous as the original strain of the virus, so we are not seeing countries around the world have dramatic economic shutdowns. In the United States, there's been very little widespread shutdowns of businesses. This is good as it leads towards another world reopening. We're still only 75–80% reopened from the worldwide economic shutdown that we had when the original virus hit. If some of the scientists are correct, this Omicron variant may lead finally to a herd immunity around the world where it may take care of people not vaccinated, and we might finally get what some people are calling not Omicron, but maybe Omnigone. So we're optimistic about that. We are very optimistic about the world economy and the economy in the United States. We believe that we're going to see a further spending by consumers, a further movement of people that want to get out, participate in the economy. We believe in services in particular. There's a lot of pent-up demand, and people seem to be adopting to what was first the Delta variant of the virus that was last fall, and now this late winter, early 2022 variant. People are adopting. They're going on with their life. They're spending money. They're working. They're being creative, even with this happening. So this is encouraging, and we believe that the world economy will be strong, that we'll probably see worldwide somewhere around 5% GDP growth. In the United States, we look for at least 4%, maybe higher GDP growth. A couple of things that lead us to believe this encouragement. This morning, Delta Airlines reported earnings. They did say, well, we saw business fall off a little bit in November, December as people worried about the Omicron variant, but their bookings going forward look very solid, and they are very optimistic about being not only IRS taxable earnings for 22, but also cash flow positive for 22. So this is just one sign. The increase in demand for commodities is keeping prices very firm. We think that continues. So let's switch from there to maybe talk about the investment markets. A strong economy getting past the variant doesn't necessarily translate to then stock and bond prices are going to move higher. Bond prices are not going to move higher. They're going to move significantly lower during 2022. The reason for this being that we're battling inflation. This week we saw yesterday and today the inflation figures at both the consumer level and the wholesale level come in showing inflation running at 7% year over year. This cannot last. The Federal Reserve Bank in the United States, the Bank of Europe, Bank of Japan, they're experiencing similar things due to the amount of money that they have printed in the last 2 to 3 years in order to massage everyone through the worldwide economic shutdown. But it is showing up in inflation. So what this comes down to is now central bankers, and in particular the Federal Reserve Bank in the United States, is openly saying we're going to increase interest rates dramatically in order to fight inflation. The question is going to be, how high are interest rates going to move by the Fed? How fast are they going to move? How quickly are they going to stop quantitative easing, which in English means stop buying government bonds in order to keep the interest rates down? And are they going to be able to manage all this and create a soft landing in the economy? You're seeing housing prices go up, you're seeing food prices go up, you're seeing energy prices go up. This has the potential to crimp consumers to the point where maybe they have to cut back spending. We don't know. We're going to have to watch this very carefully as 2022 progresses. So with that said, we see very high certainty, and it's happened so far in 2022. Interest rates are moving up on a 10-year government bond, which means bond prices are moving down. Bonds are a very poor investment for 2022 unless you stay very short, unless you stay with floating rate issues, unless there's something there to give you protection against interest rates moving up. Equities, and stocks in particular, will be something to watch. We've already seen some of the more aggressive NASDAQ stocks started really towards the part of last year have major corrections. We believe that continues. Those stocks were and still are very much overpriced. Value stocks, on the other hand, banks, energy, these companies that produce natural resources, increasing dividends, we think that's the part of the market to be into right now. And these companies don't grow at 15-20%, but yet they grow maybe at 3 to 4%, but they generate tons of cash, they're buying back stock, they're increasing dividends. And the spread between growth stocks and value stocks has never been wider in favor of growth stocks. So we believe that is going to narrow, and the markets all year long will come back more towards value stocks. With that said, Brian Curtis, a very happy new year to you and your family. Thanks for producing our shot here, and we'll be back in another 3 weeks with another update for you. Thank you.